Welcome to The Explainer. Today, we're diving into an absolute masterclass in financial strategy. Now, to make this really practical, we're going to examine a fascinating case study. Picture a bustling, locally owned Canadian bakery. Through years of early mornings and literally endless batches of sourdough, they've managed to accumulate a really healthy amount of retained earnings. Now the owner wants to systematically invest that hard-earned cash. But how do they do it without gambling away their life's work? Well, that's exactly what we're going to solve today.
You know, when most people think about picking an investment, they just look at what made the absolute most money last year. But true mutual fund selection, it's a rigorous, systematic, analytical process. It's way more than just chasing past returns. We have to evaluate the risk, drill down into cost efficiency, and really assess the human beings who are managing that money. For our bakery owner, it means building a solid framework to find a fund that perfectly aligns with the long-term financial objectives of their business.
Okay, let's dive into this. Here is our diploma-level syllabus for today. First, setting your investment foundation. Second, the math behind risk and return. Third, costs, diversification, and value. Fourth, psychology and fund managers. And finally, the step-by-step selection guide.
Let's start with Chapter 1, Setting Your Investment Foundation.
Right off the bat, our business owner is faced with a primary dilemma. What is the actual purpose of this cash? Do they want capital appreciation or capital preservation? Think about it. If the bakery wants to drastically grow its nest egg over the next 20 years to open, say, 3 new locations across Canada, they might lean toward appreciation. That means accepting higher risk for a long-term value increase. But if those retained earnings are needed to buy a massive new commercial oven next year, they need preservation. They need minimal risk to protect that initial investment, even if it means accepting a lower return.
And whenever we talk about returns, we absolutely have to talk about risk. Risk is essentially just the degree of uncertainty in your returns. You've got your standard market risk from broad economic changes, plus interest rate and credit risks. But I really want to highlight that last one, inflation risk. For our bakery, if the cost of commercial flour and sugar doubles over the next 10 years, but their invested cash hasn't grown at that same rate, their purchasing power is completely destroyed. So doing nothing with the money is, ironically, a huge risk.
Moving into Chapter 2, the math of risk and return.
Now, what's really interesting about this slide is that this is exactly what separates the amateurs from the professionals. Beginners usually just look at absolute return. They say, hey, I put in 10 grand and I got 12 grand out. But that doesn't tell you how long it took, right? The compound annual growth rate, or CAGR, is different. It takes the final value, divides it by the initial value, and factors in the number of years. It gives our bakery owner a much smoother, annualized picture of true growth year over year.
But here's the thing. Returns mean nothing without adjusting for the sweat it took to get them. Enter our risk-adjusted metrics. Take a look at the Sharpe ratio. It subtracts the risk-free rate, like a super safe government bond, from the portfolio return and then divides it by the standard deviation, which is basically the volatility. A high Sharpe ratio means the fund manager isn't just taking wild, reckless swings. They're actually getting great returns for the exact level of risk taken. And alpha? That shows us exactly how much pure value the manager added compared to the broader market.
Let's roll into Chapter 3, Costs, Diversification, and Value.
Okay, this is absolutely crucial. Notice the immense difference in future value here. Our impact formula introduces this little variable E, representing the expense ratio. Because E is subtracted every single year before compounding happens, a seemingly tiny fee, like paying 2% instead of 0.5%, will aggressively eat into the future value of the bakery's investment over time. High fees can literally cost our business owner years of hard work.
To protect those returns, we rely on diversification. And diversification isn't just some catchy financial buzzword about not putting all your eggs in one basket, though actually that's a pretty fitting metaphor for a bakery. It is a mathematical certainty. The portfolio variance formula proves that by combining assets that don't perfectly move up and down together, which is represented by the covariance at the end of that equation, you actively reduce the total volatility of your portfolio. Basically, one bad sector won't wipe out the bakery's profits.
So how do we actually apply that variance math in the real world? Through asset allocation. We divide the pie, we use equities for growth, bonds for stability, and money market instruments for liquidity. The expected return formula is simply the weighted average of these slices. By tweaking these weights, our bakery owner can perfectly balance their need to aggressively grow their nest egg with the very real need to ensure the money is still there tomorrow.
Chapter 4, Psychology and Fund Managers.
You know, evaluating a mutual fund manager is exactly like our bakery owner hiring a new head baker. You wouldn't just hire someone because they baked one really good cake, right? You'd verify their track record, their consistency, and honestly, how they handle a kitchen fire. In finance, we measure this using the information ratio. It measures the manager's excess return against a benchmark divided by the consistency of that outperformance. Ultimately, we want to know, is this manager genuinely skilled, or did they just get lucky once?
So the crucial point is understanding that even the smartest business owners fall into behavioral traps. It is incredibly easy for an entrepreneur to suffer from overconfidence, or worse, herd behavior. If every other local business is suddenly dumping cash into a trendy new tech fund, the temptation to blindly follow the herd is massive. As educated investors, we have to stick to the data and our framework, leaving emotional loss aversion at the door.
And that brings us to our final chapter, Chapter 5, the Step-by-Step Selection Guide.
Let's move to and see how this builds a really solid, actionable roadmap for our bakery owner. Steps 1 and 2 are inward-looking, defining the exact financial goal and honestly assessing how much risk the bakery can stomach. Step 3 is selecting the broad category, like equity or debt. Then we get to the analytics. Step 4 isn't just looking at the return, it's looking at that CAGR we talked about. And Step 5 is heavily scrutinizing that historical volatility using standard deviation and the Sharpe ratio.
Finally, we hit the execution phase. Step 6 demands we compare the fund against the benchmark index. Step 7 is aggressively checking costs so the expense ratio doesn't rob our future value. We review the portfolio holdings in Step 8, and we monitor it regularly in Step 9. But please look at those mistakes at the bottom. I want to emphatically warn you, relying entirely on past performance is the most common, most dangerous mistake any investor can make. You absolutely must factor in the fees, the math, and the risk.
So, I'll leave you with this final thought. When you look at your own hard-earned money, are you investing based on a structured, analytical strategy like the one we built today? Or are you just chasing past performance and hoping for the best? Thank you so much for joining me for this explainer. I really hope it empowers you to make brilliant, data-driven decisions going forward. If you found this helpful, please make sure to hit that like button and subscribe to the channel so we can keep making these deep dives for you. See you next time.